All right, I want to talk a little bit more about the road ahead for the Canadian dollar. Our next guest covers the world of currencies and sees a case growing on Wall Street for betting against the loonie. Dan Tobon is head of G10 FX Strategy at Citi and joins us with his analysis. Dan, nice to have you with us. Walk us through some of this bearish sentiment that you're starting to see in the market when it comes to the Canadian dollar.
Yeah, so there's really three things that we would point to as a driver for some potential weakness in the loonie. First is just the correlation with the U.S. economy. Canada and the U.S. are very tightly linked, and we're going through a soft patch, or it appears like we're going to be going through a soft patch in U.S. labor market data. So that can weigh on the loonie simply just from that relationship. The second factor is that there's potential for the Bank of Canada to cut more than what markets are currently pricing. Markets are only seeing one more cut from the Bank of Canada over the next year and then reaching a terminal. We see scope for deeper cuts than that. Our Canadian economics team, despite that stickier inflation that the Bank of Canada is dealing with, sees enough scope and weakness in other parts of the economy that ultimately, as we do get some more normalization on the inflation side, we should see a more aggressive path being priced and ultimately being realized by the Bank of Canada. And then the third reason is actually the removal of something very positive. The Canadian dollar has done, I would say, okay. It's outperformed the dollar. It's underperformed a lot of other currencies. But it's outperformed the dollar because of these hedge ratio adjustments. And I'm sure we'll talk about this a little bit more in a second. But basically, it's Canadians buying back the Canadian dollar. And a lot of that flow looks like it may be running out. So suddenly, you may no longer have Canadians buying more Canadian dollars. You may have some weakness in the U.S. labor market that can then, from a contagion aspect, weigh on the Canadian loonie, and then potential, once we start seeing some normalization in inflation, for the Bank of Canada to cut deeper than what's currently expected.
Okay, I like lists, so I appreciate the 1, 2, 3. Diving deeper into number 3, can you just explain more about what was driving that Canadian currency purchasing?
Yes, and this is one of those things that, as an FX person, we always know it's a big deal. But for most investors, they kind of forget about this. Let's think about a Canadian investor, and this isn't just true for Canada, this is true globally. They have been buying a lot of U.S. assets over the past decade, especially in the last 5 years. Now, if you're a Canadian and you buy a U.S. asset, you have to sell your Canadian dollars to buy U.S. dollars to buy that asset. What you might forget is that that entire period, you're not just long the U.S. asset, you're also long the equivalent dollar. Now, historically, most investors are actually happy to maintain that because historically, when equity markets go down, the dollar tends to perform well. So it's almost like a built-in hedge. The other thing, too, is U.S. rates tend to be higher, so you're actually earning some carry. So this used to be a great scenario. I can buy U.S. equities, I'd have the dollar exposure where I'm actually earning a little carry, and it's a hedge in case of risk off. Things have changed a lot this year, and as we saw back in April, we saw the correlations flip, where we saw risk off, but with that risk off, a weaker dollar and higher U.S. Treasury yields. And so what started happening is this belief that maybe the dollar isn't the hedge that it always was. Now, here's the thing. You can still own the U.S. asset, but you can remove the FX risk by hedging that FX risk. You have to pay for it. Again, U.S. yields are a little higher. So what we started seeing was a lot of investors saying, look, I own a lot of U.S. I don't necessarily want to get rid of the assets. I still want to own the S&P, credit market, et cetera. But I don't necessarily want to hold on to that dollar exposure, and I'm able to hedge it at a small cost by buying back Canadian dollars. So effectively, that's what we're seeing is we saw a huge amount of Canadian dollar buying by a lot of the Canadian pensions in the first half of the year, especially after April. They weren't necessarily de-risking their U.S. exposure, they were just de-risking their dollar exposure. But that effectively meant they were buying a lot of Canadian dollars over the last couple of months.
Okay, well, that's really helpful context. So let's just talk about charting it out. And we often look at the Canadian dollar in U.S. dollar terms. So, right now I'm looking at give or take the 72-cent level. We had been below 70 cents, give or take, sort of end of last year, coming into this year. When you anticipate the possibility of some softness or some weakness in the currency, can you give us a sense on some of the sort of the numbers you're going to be watching?
Yeah, if we want to, let's go with how you guys look at it, CAD versus dollar, right? So Yeah, maybe we can get back down to that 70 cents area. We're not looking for this major collapse in the Canadian dollar. And a big part of that is just that it's still going to have a beta to the dollar. So if we're still in a weak dollar environment and the dollar is weakening against everything, and we think that could still persist for a few more months. We're not structurally bearish the dollar, but certainly the next few months could still see some weaker dollar. It's going to be hard for the Canadian dollar independently to sell off. More likely what will happen is it'll be both the US dollar and the Canadian dollar underperforming everything else. The Canadian dollar relationship, we should still see a marginally weaker Canadian dollar against it, but it's very hard to get a situation where the Canadian dollar is weakening significantly, but maybe euro and Australian dollar and these other currencies are strengthening significantly. The betas effectively make the adjustment. So again, maybe we can get down towards 70. That's not a monster move from here, but it's something that's definitely notable. The bigger issue is then, are we going to get broader Canadian weakness against the euro, against the yen, against these other currencies?
Okay, a number of things to track there. Dan, thanks a lot. Appreciate the breakdown. All the moving parts of the FX market. Dan Tobon, head of G10 FX Strategy at Citi Research.